Good afternoon, everybody. It is May 2nd, Monday's retirement income options. And I just want to talk about a couple of things before the Fed meets tomorrow and Wednesday. What you are seeing right now are the markets adjusting to changes in liquidity. I know that it's popular to say that sentiment speaks, but I think that what is really true is that liquidity speaks and sentiment listens, or sentiment follows. And as we have gotten the message from the Federal Reserve that liquidity is going to get tighter, smarter investors, people who are less emotional, people who can turn their FOMO on and off, depending on what the market conditions are doing better. And those are the folks who raised cash in December, January, February, when I was really pounding on that. And now they're able to take a look at the market and go, there's some pretty interesting things going on. And if you take a look at my futile forecast, so from December 30th, 2021, I think you'll see that a lot of the things that I've said are basically happening. I would be surprised if the stock market doesn't reach at least the initial support levels that I've suggested, which would be middle 3,000s, so 350-ish, 360-ish on SPY. QQQ can go much lower, but once the mega caps correct, once those 50 biggest, 60 biggest companies correct, that's it. That's the end of the correction. And what we know about corrections and recoveries is that almost always it's the small caps that lead on the way out. And why is that? People always want to know, why does it do that? Well, if the end of the correction is people selling their large caps last, right? That's the people who stayed in because, well, I just stay in, I'm a long-term investor. And then they panic. So they sell SPY and VU and their large cap funds. They're not likely to get right back in. And that's why the large caps lead at the end rather than leading at the beginning. That's why at the end of this bull run that we've had since the COVID crash, the large caps are the last thing standing. So when those finally fall, psychologically, people won't be ready to buy them back right away. There'll definitely be a lot of cherries that you can pick at that time. We'll take a look at some of those in a minute. But what you really should be concentrating on now, presuming you've already gotten to your 40, 50, 60% cash level that I suggested, if you're more aggressive, probably closer to 40. If you're more conservative, probably closer to 60. And if you're a trader, maybe you never carry that much cash because you're trading in and out of things. But if you're a longer term investor, and that's really who I'm talking to for the most part, then you've already got your cash accumulated. And if you don't, I'll tell you, in your 401k or in your regular accounts, if you still feel like you need to raise cash, this is it. Maybe today, maybe tomorrow. Last chance. I would do it right now today. Sell a fund that is highly correlated to the S&P 500. If you own SPY or VU, sell it. Just sell it. Be done with it. If you own something called large cap blend or large cap growth or large cap this thing or that thing in your 401k, sell it. And remember, in 401ks, you never, ever should change what's going into your 401k. Always leave the contributions alone. Have your 3 funds or 4 funds, whatever it is you're going to do, picked out, and just keep dollar cost averaging in. Manage the balance, not the contributions. The only thing you should be doing about the contributions is upping the percentage that you're adding to the market. I went to a fundraiser on Saturday for my former baseball team, the one that I started back in 1990. And one of my friends grabbed me and said, "Hey, is the market going to keep going down?" I said, "Yeah." He goes, "Well, then I'm going to stop putting money into my 401k and I'm going to put it all in cash." And I said, do you have a free membership to my site? Are you reading the basic stuff? I don't have time for that. I'm going to say, well, I'll tell you, it's a classic mistake to reduce what you're putting into your 401k when things are going bad. I said, if all of a sudden you wanted to buy a steak and steaks went on sale, you'd buy that steak, right? He said, yeah. I go, but if the price of steak doubled, would you buy it? No. Are you sure? Well, maybe if I wanted a steak. I said, okay. Are you more likely to buy the steak on sale? He goes, oh, yeah, absolutely. So why wouldn't you be more likely to buy stocks when they go on sale? Why would you reduce what you're putting into your 401k? Manage the balance. If you want to be more conservative, take the balance and make it more conservative, but then have a plan for scaling back in. If you're going to sell today and say, I'm going to buy back in at 10%, 20%, 30% down, a third. Talked about this last week. And I'm reiterating it because I think that folks just get emotional. They make bad decisions on their finances because of fear. Other times they make bad decisions because of greed. I think that we know that fear and greed drive the markets at a certain level, ultimately probably the base level. And it has really nothing to do with the quality of what you're buying or the prices at which you're buying it. People are too emotionally driven. And so I just want to say, as things get more volatile, as things look like they can't get worse at some point, you need to be able to control your emotions. And if you listen to Warren Buffett this weekend, is that you better not be betting against America because you'll lose that bet. You might be up on the bet for a little while, but ultimately betting against the U.S. stock market or the U.S. economy or the U.S. dollar is a really bad bet. We are relatively stronger than every other large economy in the world. And there's only a handful of small economies that in their little universe might be better. So unless you're going to go live in Switzerland or Singapore or a few other places, U.S. stock market is probably your best investment. The rock that we sit on is probably your best investment. So anyway, I was telling this guy, this is what you need to do. You need to increase what you're putting into your 401k right now. If you can do that, do that. I know with inflation, it might be hard. But right now, if you've been thinking about, should I be saving more for retirement? The answer is yes. Put more and more and more into your 401k as much as you can and just dollar cost average into this and have something that's correlated to QQQ, more QQQ than SPY, or just a large cap growth fund. Most of you have that in your 401k. And then a mid cap fund, which is probably where I put most of my money, then a little in small cap and emerging markets. I will do the 401k article tomorrow. And I think it's that important. Now, when it comes to options, so we're here to talk about selling options. You need to take a look at the last several articles. That's always where you start when you're looking for options. So I'm not going to keep repeating myself. If I talked about something last week, don't expect me to talk about it this week. Looking for newer ideas. So let's get into the frame of mind. What are some interesting ideas that are out there right now that might be cheap? Yesterday in the Wall Street Journal, this might be 2 days old, they talked about how spy satellites and satellites as a service were becoming mainstream. In this article, they mentioned 3 of the 4 stocks that I've told you want to buy as a basket. They mentioned Satellogic, they mentioned Black Sky, and they mentioned Planet. This image is from Maxar Technologies. The reason why we don't invest in them is because they're fully priced. They're fairly valued. But the 4 SPACs that I recommend to you, they are at SPAC pricing. Everybody hates them. Everybody wants to say this is why they're cheap, because they're evil, because they cheated, because they lied, because they are scams. How do companies that have hundreds of satellites up in the air and they're collecting fees on them seem like scams? I categorically tell you that every single one of those companies on our list are undervalued. 3 out of 4 are trading at prices that are below what the private investors invested in a couple of years ago. So you're getting valuations cheaper than the private investors, the private equity investors got a couple of years ago. These stocks are dirt cheap. Look at this image. That's a satellite. It's not from an airplane or a drone a couple feet up in the air. It's from miles away. The satellite technology that's out there now and launching right now is so good that not only can they basically look into a window and tell if there's people in there, but they have infrared technology. They have technology that can tell what's in the air, what the radio waves are. They know whether you're talking on the phone. They have resolution down to under 12 inches now. And it's only going to get better in the next couple of years. And what's interesting about these satellite companies, in my view, is that you're already hearing the government and government agencies and special interest groups, NGOs, talk about how we're starting to put too much stuff up in space. So that means that these companies might be the last batch to really put a lot of satellites up. So these half a dozen companies might be it before the government says, let's not put anything else up there, or let's make it really hard to get up there, before they increase the barriers to entry. These companies are going to become an oligopoly. That means that the price of the technology will come down while they raise rates. And their CapEx is going to fall because they'll have their network up there. They'll have their constellations up there. And what have we learned about CapEx cycles? When a growth company builds out their business Everybody says, oh, they're not profitable. And then the CapEx goes away and the business keeps growing and they become very profitable. Amazon, I think, is the classic example. For years, that stock went up and people said it's a scam because they're not profitable. Then one year, Jeff Bezos says, we're pretty well built out. We're going to start cutting our CapEx. And then suddenly, a quarter, 2 quarters later, people are like, oh, look, they just crushed estimates and they're very profitable all of a sudden. That's actually going to happen with Amazon again. There was a poll on Twitter, gave a list of companies. Which company will rebound first? Amazon was on the list. I said Amazon. One, everybody who has analyzed the company realizes that there's embedded value in AWS, which isn't really showing up in the Amazon share price. And all this CapEx that they spent to be able to do deliveries because of the pandemic, it's over with pretty much. Amazon's building period, all their facilities, expanding their fleet, it's going to still happen, but not anywhere near the rate that it was happening for the last year and a half. And in Q4 of last year, remember we talked about this, Amazon said, we're okay not being profitable for a quarter as long as we can get everybody's deliveries there for Christmas and the holidays. They told you, I believe it was their Q2 or Q3 earnings last year, they said, hey, we're going to spend a ton of money to make sure that we've done everything we can on supply chain to make sure that when people order stuff, they get it. And they did that. And now supply chains across the board are starting to ease up. Still going to take a couple of years on certain things like semiconductors, which is a really important part of supply chains. And mining is only going to be able to ramp up as fast as mining can ramp up. I mean, they can increase capacity as much as they can at existing facilities, but it takes a while to get a new mine in place for the metals that we need. And processing, companies like MP Materials have been working on getting their processing going for a couple of years now. It's getting closer. A couple other companies are adding processing for rare earth metals. At the same time that the technology is becoming available to be able to use less rare earth metals. This is why things like sell the shortage, which you've heard me repeat now a half a dozen times. I hope it's not flying by you. Sell the shortage is important. There's only very few companies on the mining side that are really going to do well over time. Why? Because there's a few discrepancies in the pricing based on the CapEx cycles. And a handful of these companies, as their CapEx comes down, will appear to be way more profitable in the future than they are today. And really all it is that today they're spending their free cash flow on building out. At some point, that free cash flow just becomes earnings. So these satellite companies here have both things going. Their CapEx is going to come down significantly in 4 or 5 years. Barriers to entry are going to go up. And what they're collecting in revenues is going to go up. So right now, people are focused on, well, these stocks were $10 a share a couple of years ago, and now they're 7 and 5 and 2. They must suck. I hates them, right? It's like Gollum. I hates them, Bilbo Baggins. Even Gollum was a little bit redeemed at the end. With Samwise, Bilbo, right? They ended up being heroes. In this basket of satellite stocks, there are some heroes. I can't tell you which ones. We'll know when we know. But if you buy the whole basket, not just one or two, buy the whole basket. If you want to weight them a little differently, that's fine. You're probably going to get a 5x to 10x on the basket. Maybe more. That's how the numbers shake out over the next several years, just based on the growth in revenue, the CapEx falling, and then the bonus of barriers to entry from competitors. Where else can we find a lot of money to make? So they're showing me the Harry's because I bought some new Harry's blades. Netflix is in crisis. So Hollywood insiders say it could turn into a huge opportunity or Netflix could implode. Okay. So does that mean that I want to make a bet on Netflix? No. I want to make a bet on the companies that are super undervalued and might have to get into bed with Netflix. So Viacom is now Paramount and NBC Universal is owned by Comcast. Do we think it's within the realm of possibility that Netflix could use its shares to buy NBC Universal or Paramount? I sure do, because then all of a sudden they have news, they have more studios, and they could combine some operations and save a whole bunch of money, especially if they get a catalog, a library of content. And Paramount, we know that they're looking for a deal, and I'm pretty sure that we know that NBC Universal is looking for a deal, because Comcast realizes they don't really need to own it. They own the wires, that's all they need. And they're just going to charge you for access to the internet, because almost nobody has fiber optic. If you want speeds of 200 and 400, much less a gigabyte, you got to have AT&T or CenturyLink or Comcast or Charter, Spectrum. There's only half a dozen companies out there really that own most of the high capacity wires. So it's real easy for Comcast to say, well, give us a whole bunch of shares in Netflix and we'll give you NBC Universal. Let's talk about something we can do at this park over here in Florida. Maybe build a couple other ones because Disney's got their plate full. So I think the Paramount and Comcast, if you're a dividend investor, A, they're great dividend companies, and B, they're in play, which means that you might even get a double or triple out of your money. And if one of them gets into bed with Netflix, those shares on Netflix drop another 50% when you get them, but then they go up over time as consolidation in the industry finishes up here in the next few years. Holy cow. We already saw Amazon buy MGM. We saw the deal between Discovery and Warner Brothers. There is at least one more gigantic deal coming, and I think two. And then there's going to be some schnibbles around the edges. Your smaller streamers, your specialty streamers, they'll get absorbed too. And you'll end up having 5 or 6 must-own streamers, for your TV. And Warner and Paramount and Comcast are the super interesting investments right now. So let's take a look at the screener. I've been updating this. I think it's got all the companies on the VSL lists, the mega caps, the large caps, the growth stocks, and the dividend stocks. I added a whole bunch of REITs. And let's take a look at the RSI. Just make sure that everything's in here. There we go. So I'm tracking 329 companies now. A lot of these I'm not terribly interested in, but for the purposes of screening, it's very instructional. We haven't looked at Macquarie Infrastructure in forever. But look, black sky, an RSI on the weekly of 18. Don't sell puts on this, just buy the stock. If you already own the stock, you can sell puts. I'll give you an idea when I write the article this afternoon. Store Capital, RSI 24, $27 a share. And we know that Warren Buffett will buy it if it gets cheap enough. On track. We're pretty much at that point where we just have to ask, will it be in business in a few years? I actually do think they're getting bought out, so I don't know. There's a lot of money to be made here. Zoom, talking on that right now. RSI of 24. Remember, this is the weekly time frame, not the daily. Let's look at the monthly really quick. Is there anything super oversold on the monthly? What do we know about monthly oversold? We know that monthly oversold, unless there's a business problem, always leads to a rebound. So since we're in the midst of a correction, can we find companies with RSI of around 30 or lower? And we can already. On the monthly, Black Sky, Spire Global, Netflix even, it's under 200. Look at that. This one is super speculative, but it's about as cheap as you're going to get it if you want to speculate. Selectus. I remember these guys. I'll take a look at that. 52 cents. Heron Therapeutics. Again, another one. If you want a super high potential growth biotech, you really can't get Heron Therapeutics any cheaper. Now, you have to believe that it's going to be in business in a few years. That's the question you ask. Teladoc. We sold puts on that last week, and the stock went up a little bit. So those puts are profitable already. PayPal, same thing. Selling those $90 puts, I believe it was. So we'll see if it gets put to us. But if it does, that's fine. Alibaba, right? They're the canary in the coal mine for us with China. I think that this could end up being a 13 number at some point. But even Verizon, right? It's pretty cheap. So if you're a dividend investor and you just like telecoms, you can take a look at Verizon. I don't think it's there yet. I think all these numbers are going to go down a little bit more because when you take a look at the weekly chart compared to the monthly, I think that all these numbers in the 20s, you're eventually going to have monthly numbers in the 20s. So when Amazon has a monthly of 30 instead of a weekly of 30, you go, okay, I got to buy Amazon. Warren Buffett talked about how they've been active buying overseas stocks. Now, the 13F doesn't have to show that, right? They're foreign stocks. They don't have to report that. Stone Company, it's under $10 a share. And you have to really understand the way that I look at stocks too. I'm not by nature a trader. I have always found trading frequently to be counterproductive to what's best for my time and how I want to just spend my time in general. I can study these companies and then monitor them. And the study process is intensive and takes time. Once I know these companies inside and out, and I learn a few dozen a year, once you're in that monitoring phase, you understand things like CapEx cycles and how their growth rates are really working and where they have a moat compared to their competitors, or if they even have competitors. Are they parts of oligopolies? Have they monopolized something like Ametis has? I mean, that's the way you should think about Ametis, is they've really monopolized something in the 13th biggest economy in the world that happens to be a growth industry that companies like Chevron might be interested in buying. So I wanted to focus today on how to think about things and how to look. I'll write the retirement income options article with 4 or 5 new ideas. If you're not using the screener at TradingView, I really encourage you to have this, even the cheapest version of this. You don't need everything. I have the pro plan. They have a basic one that just gives you the screeners. This is what you need. Whichever plan has the screener is what you need. And then anything that comes along with it is great. But this screener is so good. And their ratings, right? They're awesome oscillator. They're I don't know what you would call this. Their aggregate oscillator rating. It's just such a good setup. I mean, this $10 a month or $15 a month, whatever it would be, just make your life so much easier. Now, if you just follow my ideas and you watch these videos, you probably get almost all the way there. The more you trade, the more you need this. If you're like 80% of the people who shouldn't be trading regularly and just selling some puts and calls here and there to add income and mitigate risk, I'll help you out. But anybody who's going to do any swing trading or even more cyclical on assets that I don't cover, because I can't cover everything, this is just a great setup. So you know where the links are on my services. Any questions about a specific thing that we're already invested in? No? Somebody points out that Amazon has changed its depreciation schedules. Yeah. So what Amazon did with their depreciation schedules is going to make them look a little bit better in the short term, but I think it just reflects the reality of the actual hardware, what they're doing. And it does for sure change their CapEx. So it changes the way their earnings will look. So Amazon, I told you that the CapEx cycle is going to make their earnings look low, but the change in the depreciation is going to make their earnings look better. And some analysts will talk about it, but most of them, and for sure the general public, is not going to have any idea what a depreciation schedule does. So Amazon is very high on my list to buy. It's, I told you a couple of years ago that Google is my favorite. Right now, Amazon is my favorite, and I think Amazon is going to come to us. Somebody asks about MP Materials. RSI of 44. I still think that I'm frustrated by what I took away one of my clicker powers. So MP Materials is right at that point where if it breaks below the yellow line and the orange line, isn't it kind of neat that it's happening right where these cross? That means our orange line was right. So if this breaks down into here, it starts to become a screaming buy in the middle 20s. I find it hard to believe that it would break below middle 20s. You'd really have to have a horrific breakdown in the markets, which could happen, in which case it gets down to around 20. But this is probably one where if you were going to sell a put for an initial position, you could do that, and you just have to live with it. If it got put to you at, 35 or 40, and it went down to 30 or 25 or 20, then your scale in is way down here. And that's one thing about scaling in. Remember, when you scale in, the price difference between the first time you buy and the second time you buy is going to be 20 or 30%, not 5 or 10, 20 to 30% every time. Then if it drops 50%, then you buy a third time. Actually, Carvana did not have problems. Somebody asked about Carvana and Kazoo. Carvana did not have problems raising capital. Somebody took $1 billion stake in it. Was it Goldman Sachs or Morgan Stanley? Just because the public is stupid. If the investment bank turns around and says, we'll take it, that means it was probably a pretty good deal and the public was just stupid. Don't put it beyond the public to be, was it Apollo? Yeah. Don't put it beyond the public to be really stupid. 4 out of 5 dentists say the public is pretty stupid. We look at your teeth. We know you're dumb. Brush more, floss. Same thing with investing. 4 out of 5 people have no idea what they're doing. No idea. The fact that everybody on this call at least has a clue is unusual. So give yourselves a hand. You're better than 4 out of 5 investors out there. Now, the trick is climbing that scale as high as we can. And usually that's going to be a function of how many multi-baggers can we pick out. Yeah, we can do some trading around the edges, swing trading, selling options. It feels nice to get those extra few points a year. But the big money really is buy and hold great companies or companies that look like they're going to be great from cheap prices. And this correction that's gone on in the small caps and mid caps, that'll be over as soon as the large caps and mega caps join the party. Is an opportunity that only comes around once or twice a decade, and it's happening now. So think about all those meme stocks that after the COVID crash tripled or quadrupled, or quintupled. And granted, a lot of them have come down 50, 60, 70, 80, 90% from then. If we sort out the really good ones and get that redo, right? It's like being on the playground. Oh, I want to redo. I want to redo. You're getting a redo. We are getting a redo right now. And the whole SPAC thing, with everybody just hating on SPACs because they're SPACs, or they used to be SPACs, they're just companies now. I'm telling you, I think that the people who load up on small caps and mid caps, then add a couple of the large caps when they finally come down, like Amazon, could double or triple their money in 3 to 5 years. I think quite possibly closer to triple. Presidential cycles have something to do with that. And if I'm right, the Fed's going to back off by autumn. That next bull cycle will start by the very end of the year. Could be another Christmas Eve turnaround. Do we have a buy box for Amazon? Let me see. Oh, look. It appears we do. This was actually updated on 4/29. These ones that say, well, I'll have to reload them. A lot of these dates are wrong. I don't know why the dates are wrong. In any case, that's what the new VSL does. It tells you when I updated the chart. And you pull the chart up, the date's actually up here too. So I think Amazon, as it approaches 2000, there's pretty big support. See, pretty big support. But you could get Armageddon zombie apocalypse pricing below 1500. We'll see. But I think as these stocks get in here, the Fed is very likely to back off because come September, I'm just telling you, the inflation numbers are going to start to fall dramatically. I think we've already seen them peak. And while there will be a handful of supply shortages in the fall on certain materials, for the most part, the 2/3 of the ships that were at sea that finally unloaded, that caused the blip in GDP because orders went down a little bit as shelves filled up with the stuff that was at sea, the whole system is starting to find equilibrium again. Take a little bit longer in certain things like oil and materials. But once it starts to happen, right, you wait a long time for it to start to happen, then it happens pretty quick. Oil is going to start coming down in the fall dramatically. I would say that oil probably ends the year closer to 80 than it does 100. People say, well, it's only $10 or $20. Well, if oil is half of inflation and it drops 20%, it's quite a dink to inflation, isn't it? And we also know that we have all the houses coming on market. And I'm just telling you, at some point, Airbnb gets a shot across its bow, whether it's taxation or regulation from the federal level or it's just market to market. And with big investors owning 2 or 3% of all the housing markets, they get that shot across the bow too. Got an election coming up. Do you think Elizabeth Warren isn't going to be out there saying, "Oh, we gotta bring housing prices down"? The rent is too damn high guy makes an appearance. So all that stuff is coming, and it'll coincide probably with these prices. Somebody asks about Ford. I think Ford is probably still, low end. We're close. You for sure can be selling puts on Ford, especially if you don't have a position. The odds of it getting really below this area, below our bottom fishing, though, I think is pretty unlikely because they've spent a year trying to get semiconductors, and those are slowly coming back online. They've paused production on a couple of things. So when those machines start building more machines, right, they'll do pretty well. Now, I will tell you, if something weird happens and we can get Ford for $8 or $9 or $10 a share, I just have to make it a double or triple position then, I guess. So somebody mentions that the F-150 sold out for next year, and that's double in production. And remember, I went to the auto show here in Milwaukee, and I told you the F-150 is amazing. Just like I told you 2 years ago, a little over 2 years ago, that the Mustang Mach-E was amazing. Ford is going to kick the shit out of Tesla. They're going to kick the shit out of them. They have better distribution. Their technology is at least equal. I think actually better. I know nobody who's a Tesla fanboy wants to hear that. I'm going to tell you a secret about Tesla. Goldman Sachs out of one half of their house and Morgan Stanley out of one half of their house, buy side, sell side, hedge fund, retail. I think Wall Street's going to kick the shit out of Tesla stock because he is so leveraged up now that this chart I put together, way back here 6 months ago, does that not look like it's exactly playing out? Tesla's going to drop at least 20 to 30% more. And splitting those shares ain't going to help. Everybody wants to think it's going to help. It's not going to help. And the Twitter deal, I'm probably going to take profits on that, about anything that's not got a covered call on it. Why? I don't think the Twitter deal is going to happen. The more I think about it, the more I look at this, the more I think that the Twitter deal was cover to sell more shares of Tesla. He sold $4 billion of Tesla last week so that he wouldn't have to use it as for margin. Don't you think it's weird that he didn't sell here, but all of a sudden he's selling in here? What does that tell you? What does it tell you when his baby, he sells 16, 17, 18 billion dollars worth of shares or whatever it's been? What does that tell you? When corporate insiders in general are selling at the highest rate in history, what does that tell you? So this is my official prediction on Twitter. The shares of Tesla are going to fall, and he's going to back out of the deal with Twitter, and he'll blame it on somebody else, and then he'll go back to being the Tesla guy. And he's going to say, Twitter, I'll still use you. I'll keep a couple shares, but I can't buy you because you're just too broken. I hope you come out of it. I'll try to help you, but I can't own you. And he's going to be forced into that as the price of Tesla shares go down. And the people on Wall Street are more powerful than him, and they're going to make that Twitter deal not happen by forcing down the price of Tesla. You want conspiracy theories? Skip them. Just ask this question. What is the money telling you? Best advice I ever got from my grandfather was, if you want to know how something really works or how it's going to work, follow the money. And this is what's going to happen. Tesla is going to get beat up, and the Twitter deal is not going to happen. Now, I'm going to hedge my bets. I'm going to keep my Twitter shares that I have covered calls against, but I'm going to sell everything else that doesn't have covered calls on it. I might even sell the covered calls because I know I'm profitable on them. But just in case I'm wrong, because that happens once in a while, I asked my ex-wife, just in case I'm wrong and the Twitter deal goes through, I want to have some of that upside. And I think that the options, the covered calls I wrote for July, will expire because they're $55 covered calls and the buyout is at $54.20. So those covered calls are going to expire, and then I'll just have unencumbered shares. If the deal goes through at $54.20, then great. Maybe they'll let me write more covered calls. We'll see. I know that some of you followed along with that trade and did really well. Those options were pretty profitable. One thing I will just say to close here is that you need to be checking the chat room, because if I have like 3 sentences to write, I'm not throwing it into an article. I'm throwing it in the chat room and saying, hey, this is what I'm doing right now. And then you can follow along if you want to follow along or if you don't. So if you're looking for more ideas, just had somebody quit the service saying, oh, I don't know where to find anything. I mean, I've been simplifying everything. But for short-term trades, kind of quick hits, or just to get, a few more sentences on what I think based on a question that pops up, which is usually where it comes from, please check the chat room at least a few times a week. They'll have you for more than a few minutes, but it's a helpful place to go. And I know that only about a third of you are using it. It's a good resource. You should be checking in. And we have Teresa does the weekly chat review, which is posted in the chat. There's a PDF in the chat every Friday or so. I think it's Friday or Saturday, when she gets to it. And she puts some of the most important things that were in the chat. And what's nice about it, I was just here a second ago, is she takes things from both chat rooms, the one at Fundamental Trends and at Margin of Safety, and she puts it in there for you. So it's mainly a margin of safety summary, but she'll throw in a couple things from Fundamental Trends too. So if nothing else, just come and check a look at, some of the things that jumped out at her. All right. I am going to work on a couple of pieces, and then I'm going to go get my girlfriend and head over to see Grandma, who's not doing so hot. All right, everybody. Take care. Have a great day, and play defense.